Welcome to Today Breaking News. Here's a highlight of the day. Wall Street's week ahead, recession fears loom over U.S. value stocks. New York, July, fears of a potential economic slowdown are clouding the outlook for value stocks, which are outperformed broader indexes this year in face of surging inflation and rising interest rates. Value stock, commonly defined as those taking into account discount for metrics such as book value or price to earnings, have typically underperformed their growth counterparts over the past decades when the S&P 500 gains were driven by the tech-focused giants such as Amazon.com. Thus, dynamic shifted this year as the Federal Reserve kicked off the first interest rate hike cycle since 2018, disproportionately hurting growth stocks, which are more sensitive to higher interest rates. The Russell 1000 Value Index is down around 13% year-to-date, while Russia this month, however, fears that the Fed monetary policy tighten could bring on a U.S. recession have shifted some momentum away from value stocks, which tend to be more sensitive to the economy. The Russell Value Index is up 0.7% in July. If you think we are in a recession or are going into a recession, that does not necessarily work to the advantages of value stock, such as Carson, chief executive at Horizon Investment Services. The Nasdaq's shift to growth stock is one example of how investors are adjusting portfolio in the face of a potential U.S. economic downturn. Both Global Research on Thursday cut its year-end target price for the S&P 500 to 3,600 from 4,600. The index closed to as 3,863.16 on Friday and is down 18.95% this year. Corporate earnings arriving in force next week will give investors a better idea of how soaring inflation has affected company bottom lines, with results from Goldman Sachs, Johnson & Johnson, and Tesla among those on deck. For most of the year, value stock benefit from broader market strength. Energy shares, which comprise about 7% of Russell 1000 Value Index, soared over the first half of 2022, jumping along with oil prices as supply constraints for crude were exacerbated. But energy shares, along with crude prices and other commodities, have tumbled in recent weeks, and concerns that recession could sharp demand. A recession also stands to weigh on bank stock, with a slowing economy hurting loan growth and increasing credit losses. Financial shares represent nearly 19% of the value index. An earnings beat from Citigroup, however, buoyed bank shares on Friday, with the S&P 500 Banks Index gaining 5.76%. At the same time, tech and other growth companies also tend to have businesses that are less cyclical and more likely able to weather a broad economic slowdown. People pay a premium on growth stock, where growth is secured, and Burns McKinney, portfolio manager at NFJ Investment Group. JP Morgan analysts earlier this week wrote they believe growth stocks have tactical opportunity to make up lost ground, citing cheaper valuation after this year's sharp sell-off as one of the reasons. Value stock proponents cite many reasons for the investing stock to continue its run. Growth stocks are still more expensive than value shares on a historical basis, with the Russell 1000 Growth Index trading a 65% premium to its value counterpart, compared to a 35% premium over the past 100 years, according to Refinitiv database. Meanwhile, earnings per share for value companies are expected to rise 15.6% this year, more than twice the rate of growth company Credit Suisse estimates. Data from UBS Global Wealth Management on Thursday show value stocks tend to outperform growth stock when inflation is running about 3%, around a third of the 9.1% annual growth U.S. consumer prices. Just cutting had of asset allocation North America at Columbia threatened believes a possible U.S. recession in the next year would be a mild one, leaving economically sensitive value stock primed to outperform in growth. If I had to pick one, I'd still pick value over growth, he said, but thus conviction have come down since the start of this year, Putin said. Thank you for subscribing our channel. I see you in the next newsletter.